guys, welcome back to another episode of Life with Kyle. Today is May 10th, 2020. Happy Mother's Day to everyone out there watching this. I hope that you have told your mother Happy Mother's Day because it will put a smile on their face beyond belief. But nonetheless, guys, I'm going to go ahead and jump right into some stuff. We've had a bit of news come out over the weekend. A lot of stuff I want to be talking about. Some important things that have really been on a lot of people's minds lately. We got the Bitcoin halving event coming up, and I'll give my input on that, what I think could potentially happen on there. We've got a lot of stuff coming up from the Fed this weekend that I'll be reading up on and showing you guys here shortly. Potential funding coming out. And also a lot of bankruptcies that are beginning to file suit. So we'll get into all that. I'll give you my thoughts, my ideas, my opinions on it, and how I think it could impact the market. But you never know with Jay Powell revving up his printer what could go on. But we'll go ahead and take a look at the futures right now, and we'll get started with that. So without further ado, guys, let's jump right into it.
Alrighty, guys, so I want to take a look at the first thing. Like I mentioned, the futures index here. We are using Bloomberg right now, and they're indicating that the futures mark, of course, did open negative at first. Jay Powell probably saw that and was like, oh crap, we got to get something rolling. Started pumping some money into it. Futures are now indicating a gain of 88 at open, or 0.33% at open in the markets. We're a little higher earlier, but have somewhat sold off. So I just want to make a note here. Futures don't trade like the actual equities market. When you've got this much selling coming down in correlation with this much buying immediately coming back up, clearly the Fed is putting money in the futures market in the after hours when nobody else can trade. So that way it's not as noticeable that there's money being pumped into it. So I've kind of made that connection there. I've seen that. It's really frustrating, I know, but it's just another way for them to rig the market. They just want to do what they want and have what they can, but it's only sustainable for so long, so we're going to let them do what they want until, we begin to see a change. So, nonetheless, guys, that's just something I wanted to point out here. Futures are indicating, as of right now, at 8:06 p.m. Eastern Time on May 10th, 2020, we've got a gain right now of 80 points, or 0.33% at the open. So, we'll monitor this. This may probably level off or may shoot up more, but there hasn't been any positive news over the weekend for this to really have a correlation to go up. So, clearly, the Fed's just revving up their printers right now, but we'll take a look at some news that I think actually would have a negative impact if markets were behaving as they should. So let's go ahead and look at some things right now. So a big topic right now, Bitcoin halving event coming up tomorrow, May the 11th, 2020. This happens every 4 years. Basically what it does is it cuts the amount of Bitcoin you can mine in half. So if you think of this like as a commodity of gold, like the creator intended it to be, whenever demand is high and supply is immediately cut short, you would think price is skyrocketing. But given the way Bitcoin reacts with halving events, I don't particularly seeing this skyrocketing like people will say. There's usually a delay in the reaction of the halving event to when people, see the price skyrocketing like it has in the past. In all honesty, just from my own opinion, it's holding great value, but I think it will test lower. I don't see this going up right now. I think it's too overhyped, and thus people are buying in. But those who have been holding their pockets since this tanked back in March, there was a statistic out that around 86% of the people that had Bitcoin in their wallet had been holding it since the crash in March. But you can see all of the transactions being processed right here live. This is one of my favorite terminals here to use. I just use a crypto watch terminal. But it indicates a lot of stuff for me. I like watching this, but as of right now, I think Bitcoin still has a little bit more room to go down. I think it's just a lot of people trying to hype this up for the halving event, thinking it will skyrocket, but that's never been the way Bitcoin's worked, especially in the crypto market. So I think this is going to probably test a little bit lower, but the halving event will have a significance. It's just not going to be as soon as people think. So this was a good thing to take a look at. I know it's been on a lot of people's minds. A lot of other YouTube channels that talk about investing in the crypto market have brought this up. And, as I do trade in the crypto market, it's something I've been watching, but I think it's, honestly, in my opinion, I think it's too overpriced. Again, this isn't investing advice. This is just what I see, what I think in my head when I view stuff like this. So in my mind, I see this as too much. It's too overpriced. I think more of an entry point that I would be enticed to get into would be around the $6,000, $5,000 range, which I think will occur after the halving event. Once people see that it's not going to go up anymore, it's not going to do anything, it's going to sell back off, then in which I might consider buying back in. But just as of right now, we had a huge spike last week, kind of leveled off a little bit more. It's fluctuated within this range for quite some time, and then it spiked back up here at the beginning of this week. And all of a sudden, last night, I think around midnight, it actually just tanked over 1,000 points, and it's been slowly up and down ever since. So usually not a good indicator coming up to a halving event. So I'm just going to watch this. I'll let you guys know kind of what comes on. But this was just something I wanted to point out. A lot of our indicators are also saying it's tremendously overbought right now and it's losing value. So that's not a good sign again as well. So we'll watch this. But yeah, that's just my 2 cents on it. I think that, just for my own sake, if I were looking at this in my head, I would say, yeah, no, this isn't a great sign. Too much selling volume going on relative to the buying. So I think the people that have been holding this in their wallet are probably going to end up dumping it here shortly after the halving event once everybody has bought it. So that's just the Bitcoin segment, guys. Let's get into some more of the equities market stuff. So I want to start off with something that's making every investor tremble at their knees. The U.S. is risking a second coronavirus wave and a depression, economist Mark Zandi warns. Now, we see news headlines like this all the time. We think it's just trying to invoke fear, stuff like that. But when you have a market that's rallying, imagine if everybody said everything was fine and the stock market's a reflection of the economy, and yet the stock market is literally lower than it's ever been. And they're saying everything's fine and jobs are going to come back. People will not listen. But you do have a few headlines that actually make sense with what everybody believes should happen, such as this, Mark Zandi. So let's take a look. This should have been one of the economists they pulled in our last video when we said that they made no sense with the unemployment numbers, but we'll get into that later. So it looks like he's basically taking an analysis that he's getting increasingly worried that states are taking a large gamble by reopening businesses too early or too quickly. So as a result, of course, if that happens, a virus could spread, more infections. He also warns a spark in new coronavirus infections would send the economy further into a tailspin, especially since there's no vaccine. Well, hold on. I don't get that. How could there be more of a tailspin if we're not going to have to shut down like we did last time, just based off of what Kudlow was telling us and what everybody's been saying? Well, yeah, we won't, but who's going to go out and do anything if the virus is still a potential threat? Your general consumer will not go out and spend money if there's still a threat in the area. All these big parks, all these big travel industries are still going to suffer from that even more so than what they already are. Again, it's stated right here, if we get a second wave, it will be a depression. Now, let's get something straight. A recession will be 2 negative quarters of GDP. Anything more than that, going into 3, 4, etc., is a depression. So in this case, he thinks that if a second wave of coronavirus comes up, it will deter the consumer from spending any more money than what they thought they would have done. So therefore, it will lead to more negative quarters of GDP growth. I firmly think we're going to go ahead and already hit a depression just because every single country in the world is allocating so much money to fight this virus that there's no way they're going to be able to purchase anything or export anything because they're not going to have any money. They're not going to have any growth. Nobody's going to be working at this time. So I think that's going to have a prolonged effect, an exaggerated effect on our stock market that has yet to be really factored in. So he thinks we will get a second wave, and if so, there will be a depression. And if we continue to scroll down, we'll see it's critical. It's a necessary condition for the economy to fully recover. He goes on by saying, we're going to see the market reevaluate things at some point. Well, of course we will, because the only people buying anything in the market right now is the Fed. This headline alone has every single investor trembling from their knees. Trembling, guys. Like, nobody's going to buy anything right now when there's a risk that their money could go to waste. Why would you buy something? Unless you just want to gamble and try to get lucky, which is the stupidest thing you could do in a market like this. Who's going to buy anything? Most people buy shares in a company to turn dividend, to turn profit just by holding the shares. And of course, if the company's doing well, their stock's going to keep going up. But right now, no company's guaranteeing that their stock's going to go up, that they're even going to be doing well in the future. So why would anybody risk buying a stock or investing in anything to drive the market up when there is absolutely no demand for anybody to want to buy anything right now? Of course, the Fed's inflating this, and as he says, we will have to reevaluate things at some point. As I've said, I think the bubble is going to burst again. As to when, nobody knows. I can't predict that, but I think the banks are going to be the first indicator for when, everything's about to go south real fast. So this is a great article. I liked reading it. It's a little more insight from an economist who kind of actually understands global economics a little bit better than the average consumer, than the average economist they clearly reviewed in our last article. But I thought this was an interesting point. Keep that in mind. Watch the cases. Watch the resurgence. Now, they might just leave it on the DL and not really tell anybody that, hey, we've got an increase in cases. But just stay mindful. Do your own research, because little articles like this, people think, oh, it's just a negative article, whatever. I don't really care to read it. No, there's good reason behind it, because this is what investors are looking at, all right? So let's move on and let's see some other impacts of why GDP probably won't be going up here anytime soon. So this is my favorite headline of all. Again, this is no idea why the market's going up. Clearly, when you get a headline like this, and Steve Mnuchin is actually coming out and saying this, and you see Mnuchin says job loss numbers will get worse before they get better. Unemployment may hit 25%. What in God's earth is going on? How are they telling us unemployment's going to decrease when we reopen the economy? We've begun reopening partial parts of the economy, and yet they're expecting unemployment to increase still? Come on, give me a break. How is someone going to tell me and explain that to me? How is that going to make sense for anyone? How can you say it's going to get better and then start opening up the economy, expect people to go back to work, and still have unemployment growing? Get the freaking crap out of here. The real unemployment rate, which includes people who are not looking for work or are unemployed, already stands at 22.8%. Mnuchin acknowledged that the jobless rates may be even higher and stand at 25%. And just for the record, guys, when they come out with unemployment rates, whether it's monthly or weekly, those are just estimates. The actual values, 9 times out of 10, are a lot higher, hundreds of thousands of numbers higher than what's actually reported. Because they would rather be more risk averse and be like, this is probably more accurate than actually overestimate. So they always underestimate everything. Remember that. This is no fault of American businesses. This is no fault of American workers. This is a result of a virus. Mnuchin told Chris Wallace during an interview on the Fox News Sunday, the reported numbers are probably going to get worse before they get better. He added, the next year is going to be a great year. Yeah, we keep hearing that, but with unemployment numbers still growing as we're beginning to reopen parts of the economy, how long can you say that for before people stop believing you? I've come up with the theory that if Trump gets reelected, this market will remain inflated and will stay afloat. But if he doesn't, it's just going to go to crap. He's going to let it fall apart regardless of what happens. Not necessarily he himself will let it fall apart, but I've called it before to where we'll hit a recession if he doesn't get reelected. But if the recession hits before he gets reelected, he's going to try to use it or have an argument to rally people behind him. Again, not liking to get into politics too much, but those are big factors that you will see politicians feed off of. So watch that closely in debates. You'll see them mention stock market. You'll see them mention coronavirus repairs, coronavirus reaction time. You'll see all that come up. And there's a reason investors pay attention to stuff like that. Further down along the article, the biggest negative shock to an economy that we have ever seen in our lifetimes. It hit an economy that in January was about the strongest economy we'd ever seen, explained Hassett on State of the Union. The fact, though, is with all of the aggressive bipartisan action to toss maybe as much as $9 trillion at this sort of bridge to the other side, we see things like the jobs report on Friday. Almost everybody who declared themselves unemployed said they expect to go back to work within 6 months, he added. 6 freaking months of all these people not spending money, not having the proper amount of money, all these companies not being able to operate at full capacity. Companies cannot operate like that. If their accounts receivable at one time was really high and they were counting that as liquidity, now all of a sudden it's still low, you're going to get things like this. Starting with department stores because they have the most overhead. According to the CNBC article, department stores had an insane week. Here's everything that happened. You scroll down a little bit. It was another onslaught of bad news from America's department store chains this week, and that likely will not be letting up anytime soon. Department stores have the biggest overhead of anybody else, along with those that rent cars. Hertz, again, another company that's potentially filing for bankruptcy. Anything with immense overhead is probably going to file for bankruptcy. So we go on to see that stores like Neiman Marcus, as I mentioned in my previous videos, already filed for Chapter 11 bankruptcy. Macy's announced Thursday that it plans to delay its quarterly earnings report for the period ended May 2nd. Oh, shocker. They can just do stuff like that. JCPenney said in an SEC filing Thursday that it elected not to make a $17 million interest payment due on its senior secured term loan. And if you look right here, filing for bankruptcy is one option the company is considering. A person familiar with those discussions has told CNBC. So I think JCPenney probably just sometime this week will announce that they are filing for bankruptcy. Their stock has been really cheap lately. They're honestly I want to say 18 cents a share right now. So anything like this is just astronomically high. They've got way too much overhead. And if they're not expecting the people to come back to work for 6 months and they're already $17 million behind on interest payments, that's going to astronomically accrue over these next few months. So JCPenney's there. Lord & Taylor said that Liquidators is preparing to liquidate its 38 department stores as soon as they can reopen again. Oh, wow. Imagine being able to go back to work and all of a sudden your boss telling you, hey, nope, sorry. Yeah, that looks like jobs are coming back. Fantastic. Nordstorm announced that it permanently closed 16 department stores. Hey, come back to work, JK, we're closing your store. This is crazy. If they don't expect people to come back after 6 months, and department stores, just like back in 2000 when the one bank went, then another, and then bam, everything went with it, this is exactly what's going to happen, guys. It's going to start with these little department stores, and it's going to trickle down like an avalanche into every single sector of the economy. This isn't something that can just be corrected by pumping money into the stock market. The stock market is being used to control rational fear. When people see that the stock market is up, they don't think the economy is as bad as it is because the stock market is supposed to be a reflection of your economy. Well, clearly our economy is doing pretty freaking great with all these companies filing for bankruptcy, am I right? So that's something that people need to understand is that this is a big blind bluff that the Fed is pulling on everyone that's going on in the stock market right now. I do not see any of this coming back within 6 months. All these people looking, it's insane. I can't believe they're actually doing something like that and just basically prolonging the inevitable. All of these Keynesian economics, all these people that believe that the government should not play a role in interfering with the economy, basically gone out the window because the government is basically about to own everything, just like communism. So yeah, take it with a grain of salt, say what you will, but this is communism. We are living in a communist state right now, a communist country, because our government is buying everything up, because they will not let it fall, because they've inflated it to such an extent that if they let it fall, it will be the collapse of their entire government system. It is definitely systemic. This risk here is massive, and that is why no investor is buying into the market right now, because this risk is systemic. So, but there may be something we can get later on in the week. Let's take a look at something that's coming out. Retail sales. Fed Chair Jerome Powell, our boy JP over here with his printer, speaks what to know in the week ahead. Of course, as it says, retails are expected to plunge 11.4% in April following a record 8.7% decline in March. Is that kind of weird? Why did it go from 8.7 to 11.4 and actually increased in April? Stuff still isn't open. We're only partially open. They don't expect it to continue to decrease, even though April probably is going to be worse. Yeah, okay, sure. Just talks about basically what we, looked at. The previous article, the consumer represents about 70% of GDP and was considered the bright spot in the U.S. economy prior to the coronavirus outbreak. Oh, shocker. Anyways, guys, so this is the biggest thing coming up this week. Meanwhile, investors will be tuned in on Wednesday when Fed Chairman JP speaks via webcast hosted by Peterson Institute for International Economics at 9 a.m. Eastern Time. He's expected to speak about the current issues facing the U.S. economy. Probably just going to come out and be like, yo, we've run out of ink in our printer, but we just replaced that cartridge, so we're going to get some more dollars rolling out. Should be able to prop up the economy a little bit more and inflate it for, some more time before we really screw everybody and let this market tank. Trump should really just come on TV and be like, hey guys, brace for impact, but nope, we're going to let our buddy JP here try to be the guinea pig and see what happens when he talks. It goes on, Powell's webcast comes after the Fed's late April meeting in which the committee announced that it would keep short-term interest rates near zero until it felt that the U.S. economy weathered recent events. Additional clues on the Fed's outlook for the U.S. economy will be the focal point for market watchers. Yes, because nobody's going to be investing right now. Again, these interest rates are going to be remaining near zero. Watch the U.S. 2-year bond. That's getting very, very close to going negative, and I think when it does, a lot of other stuff will begin to trickle down with it. It actually just hit its lowest low of, I believe, 0.11% on Friday. If you want a good picture of where the stock market's going, you can always look at the bond market because that is basically the government and how the economy is doing. Clearly, there's a discorrelation there. And again, with having rates near zero, yet making it exponentially harder for the consumer to actually get approved for a loan because these banks aren't going to take that risk because they're about to get sincerely screwed, it won't matter. People are factoring in 0% interest rates, even negative percent interest rates in the market. Again, people, I say the Fed. And when that happens, of course, assets begin to increase because the dollar value then becomes worth less. But who knows? This could all change. I could be totally wrong. But, you hear my thought process. You can tell me in the comments if I'm wrong. I really don't care. I'm telling you how I invest, and I tremendously do not want to put my money into something and expect to lose it. I want to know that what I put my money in is going to get me more money. So this is why I'm saying this. This is why I'm so furiated with what the Fed is doing because it's complete bullcrap how they can just keep inflating something. Imagine putting trillions of dollars into something that doesn't work. You could be Thomas Edison, you could be Albert Einstein, you could probably develop a light bulb, you can find 100 ways for it not to work. Clearly the Fed has found 101 ways to not keep our economy afloat. You're going to put money into it, watch, it's going to fall again. It's not if it falls again, it's going to be when it falls again. You can't keep this sustainable. Keep pumping $1 million in there. Watch what happens. It will fall. So this is insane. I don't get, again, why they're going to come out, but he's going to come talk. Listen closely to this. Again, when I upload my video on Wednesday, I'll recap what he's talking about and what it means in actual consumer terms to where people can understand what this man is saying. Because they're really slick with what they say, guys. They are very, very sly with what they're trying to mean. There's a reason they are intellectuals. There is a reason they talk and that they have the smoothness in their voice to convey their message without making it seem like a big deal, when in reality, it is. Alrighty, and last but not least, our buddy Kudlow says the White House holding informal talks with lawmakers on next steps in coronavirus relief. Oh boy, more money coming out. Why do you need to give us more money if you're expecting the economy to reopen and people get back to work? Unemployment right now is giving more money to somebody who files for unemployment than they ever have in the past. And I think they can get it for like up to 6 months. I haven't really looked into it too much, but I know there's an increase for a certain amount of time. And so why would the general consumer who's working 9 to 5 shifts, why would they go back to work earlier if they can stay on their Corona-cation, make this money, and not have to go back to work? That's going to be another reason why I believe these companies will suffer more, is because people will delay their return to work just because they can stay on unemployment and get more money than they would going back to work. So the only way these corporations will be able to get people to return to work is if they either pay them what they were getting on unemployment or pay them more than what they were getting on unemployment. And from my take, I would have to pay my employees more than what they're making on unemployment just to entice them to come back to work. Granted, I am self-employed, I'm my own boss, so I don't really have that issue. But from a business standpoint, that's what you will have to do. He goes on to say, it's not that we're not talking. We are. It's just informal at this stage. Meaning, they've discussed the idea of like, yeah, there might be a need for potential stimulus. Oh my gosh, you think so? Probably because the 33 million people unemployed are going to need more money. Oh boy, yeah, of course they're going to, because people can't see this. This is going to be a huge factor. I'm going to monitor this closely because markets like to react to stuff like this. Excuse me. No, I don't even want to say the markets anymore. The Fed. When I say the Fed, I'm talking the Fed as in the stock market, because clearly the Fed owns the stock market right now. So the Fed likes to react to this and have a reason to prop the markets up. No news is good news, and bad news is great news for the markets. That's the way I'm seeing the markets react right now. No news is good news. Bad news is great news. So it looks like everything's topsy-turvy. But we're going to continue to monitor this, see what comes up. We've got a lot of stuff coming out. This headline right here was kind of interesting. Distance himself for the next couple of days. What, they don't have like a 5-minute test that they can give to the White House representatives? What the heck? Why would he even have to distance himself if he can take the test, know if he's positive or negative? Give me a break, guys. Of course, because if any of these guys announced they had the coronavirus, it'd be the end of the world. So this is serious. The fact that they've already done $9 trillion and are still in talks for more just shows that they're pumping money into a failing system. The systemic risk that is involved from this coronavirus is astronomical. I don't see this having any great impact, and it's just, if they want a solution to this, you must give the money to the people. Give trillions of dollars to the American people. Don't just give them $1,200 checks. Give them money to say, hey, instead of us giving this to the banks, putting it in the stock market, we are giving it to you guys. When we give it to you guys, we are going to need you to spend it. Tell them straight up, tell them honestly, say, you will have this money, but you will need to spend it. And of course, they will spend it. Put it directly into their bank accounts, have access to see what's going on. If the money isn't being withdrawn, charge them interest on it for having it in the account, but they have access to it. And so long as they keep taking a certain amount out every month, they're never going to be charged. Let them spend the money. Give the people the money. Let them spend it. Let the economy recover on its own. That way, I guarantee you, if you give people X amount of dollars, they'll buy this, they'll buy a car, they'll go buy a new laptop, they'll buy this. They will buy stuff. You just need to give them the money. But in this case, that's not the problem, because the Fed's going to keep buying the money. They're going to need the money to keep propping the market up. They're just going to keep doing all these insane bills that are just going to end up screwing people in the future. PPP loans are now being discussed as being non-forgivable. So if you got a PPP loan, props to you, because it doesn't look like you're going to be able to write that off in your taxes, and it looks like you're going to actually have to pay for it. So this is what's going on, guys. This is 2020. This is reality. When I hate to say it, but when, that hits the fan, this is going to go bust. And I don't want to say, told you so, I'm right. I'm just going to monitor this and be like, guys, the whole point of me making these videos is to keep you informed with what is actually going on. The general consumer does not understand the actual scale of the impact that this is going to have on everything in our lives. This is going to impact our future tenfold. Just like it did when we had our recession, everything changed with our laws, getting loans, approvals for housings, whatever it was. It had a drastic impact on how we did everything thereafter. This is going to be the exact same thing. But when they're telling us stuff like the market's coming back, this is happening, we're looking at this, more stimulus, and they're saying everything's fine, jobs are going to come back, that is a humongous red flag to investors that, yeah, this isn't over. We're not done yet. So why would they be telling us unemployment numbers are going to get worse before they get better if they're expecting them to get better? Because that's how they prepare people for what is coming. So, guys, I'm stopping right there. This has just been too much. This is just what's come up over the weekend. We're going to have some great stuff to talk about on Wednesday. I hope you will tune in for that. As always, guys, I hope you had a wonderful weekend. This was our weekend recap, our Sunday briefing. Let's see what happens Monday morning. Tuesday, we'll reconvene Wednesday and discuss what the Fed has gone over and some other stuff that may have come up as well, and possibly more into the Bitcoin halving event and what we thought was going to happen if it had happened. Other than that, guys, I appreciate you so much for tuning in to Life with Kyle. Again, guys, this isn't investing advice. These are my thoughts. This is what I see, what I'm interpreting, and I'm speaking them out loud and putting them out there for you to listen to get another perspective. You know, it's my favorite verse in the Bible. As iron sharpens iron, so does one man sharpen another. So this is a perspective for you guys to see, take from it what you will, and apply it yourself and learn from it. But don't let these clowns fool you. There's so much more going on behind the scenes. Why would you need to put more money into something if you think it's going to get better? Why do you have to keep doing all like they're trying to build a bridge between this, but you can't build a bridge to something that doesn't exist. They're trying to reach a place that is now unattainable just because of what they had years ago. Why do that? Let it go down. Let people get stronger. Give the money to the people. Build up together stronger from this. Don't keep trying to bridge the rich to the rich. Bridge it from the people to the future. That's how you get past this. But they don't see it. This is what happens when you get boomers running countries. This will change. Everything will correlate. And of course, eventually stuff will correct. Anyways, guys, I'm going to stop this here. But we'll reconvene Wednesday. Hopefully you have a wonderful weekend, guys. A wonderful week. Stay safe. And we will talk soon.